And if the United States no longer wants to lead, Canada will. Canada is strengthening our trading relationships with reliable partners.
On April 5, 2025, Canada cut off its biggest energy partner, the United States. 2 days later, Qatar locked in a massive gas deal with Europe, rerouting over $100 billion in trade away from U.S. ports. Trump fired back with tariffs, but instead of restoring control, he may have triggered a global shift. Gas prices are rising, allies are drifting, and the dollar's grip on energy slipping fast. The energy world just changed overnight, and America might not be the one calling the shots anymore. On April 5, 2025, Canada quietly made history, not with headlines but with redirection. For the first time in over 70 years, it rerouted its liquefied natural gas exports away from the United States and toward Europe and Asia. The move came in response to Trump's revived 10% tariff on Canadian LNG, a policy meant to pressure allies but instead fractured one of America's longest-standing energy partnerships. Prime Minister Mark Carney publicly declared the post-war alliance finished, announcing a sweeping strategy to reduce U.S. reliance and expand ties with more stable global buyers. At the center of this shift is LNG Canada, a $40 billion terminal in British Columbia, which went operational in mid-2025 and now directs the majority of its exports across the Atlantic and Pacific. According to Reuters, over 75% of Canada's LNG volume this year is bypassing the U.S. entirely. With new eastbound pipelines, expanded port access, and re-engineered shipping routes, Canada's energy map has been redrawn, and the United States has been left off it. The real question now isn't why Canada walked away, but why Washington thought it wouldn't. While Canada was redrawing its export lines, Qatar was rewriting the rules. In April 2025, Qatar Energy signed a 25-year LNG deal with Germany, one of the largest in European history, just as its massive North Field expansion kicked into high gear. Already the world's top LNG exporter, Qatar is now racing to nearly double its production from 77 million to 142 million metric tons by 2030, with much of that acceleration happening now. According to the Drewry Shipping Index, Qatar's LNG undercuts U.S. prices by up to 18%, a figure that's hard for Europe to ignore, especially as it scrambles to replace Russian gas. But Qatar isn't just supplying fuel, it's exporting influence. These deals are bundled with strategic infrastructure investments, ports in Italy, pipelines into the Balkans, even logistics partnerships with EU energy firms. An April report from the International Energy Agency put it plainly: they're selling gas and rewriting the balance of power. While U.S. terminals operate near full capacity and struggle with bottlenecks, Qatar's tankers are sailing uninterrupted, delivering both energy and diplomacy in equal measure. In March 2025, Donald Trump signed an executive order reintroducing steep tariffs on Canadian LNG and Chinese EV components, branding it as America First Energy Independence 2.0. But instead of regaining control, the move accelerated a retreat. Within weeks, Canada redirected over $30 billion in LNG contracts to Europe and Asia, while the European EV Battery Alliance quietly froze all U.S. negotiations. Gulf Coast ports in Louisiana and Texas reported a 19% drop in LNG shipping volume by May, according to the U.S. Energy Information Administration. Meanwhile, gas prices surged nationwide, reaching an average of $4.89 per gallon, reigniting fears of inflation. Trump's tariff push, meant to protect domestic industries, ended up isolating them. And with Qatar and Canada expanding their global reach, Washington is left reacting to moves it once dictated. The unintended consequence is clear. While the tariffs were designed to flex American muscle, they exposed just how vulnerable that muscle has become. In January 2025, a sudden shutdown of Russian gas pipelines through Ukraine forced Europe into an energy sprint. What began as a crisis quickly evolved into a long-term overhaul. With Russian supplies off the table and American LNG facing rising costs and logistical delays, Europe turned decisively toward new partners. Within 3 months, the EU signed multi-decade supply agreements with both Canada and Qatar, effectively bypassing not just Russia, but increasingly the United States as well. This shift is backed by massive infrastructure spending, over $60 billion committed by Germany, France, and Spain to expand LNG import terminals, upgrade storage capacity, and fast-track pipeline integration across the continent, according to a European Commission Q1 2025 report. But this isn't just about supply. Europe is walking a tightrope between energy security and climate commitments. While some nations like Germany and France are pushing for a full Russian phase-out by 2027, others, Poland, Hungary, and parts of Eastern Europe, are advocating to keep the Russian tap open a little longer to avoid domestic price shocks. The result is a bloc divided yet rapidly transforming. Europe isn't just switching suppliers, it's attempting to build a cartel-proof grid that prioritizes resilience over convenience. In doing so, it's not just reacting to the global energy shakeup, it's actively redefining it. Beneath the surface of the gas wars lies a quieter but far more strategic battle, the race for control of the electric future. In March 2025, the U.S. slapped a staggering 145% tariff on Chinese electric vehicles and battery components, citing national security and unfair subsidies. China responded swiftly, suspending exports of key minerals like lithium and rare earths that are essential for EV production. While headlines focused on LNG and oil, this tit-for-tat revealed the real prize: dominance over the green tech supply chain. Europe, sensing the fracture, pivoted. Within weeks, the EU began deepening partnerships with Canada, tapping into Quebec and Saskatchewan's lithium reserves, and accelerated negotiations with Australian and African suppliers. Meanwhile, Qatar quietly invested over $2.1 billion into Europe's EV charging infrastructure, embedding itself not just in fuel delivery but in the future of mobility. Unlike the US, which remains focused on fossil dominance, Qatar and Canada are playing a longer game, fueling the transition while locking in influence. As one Morgan Stanley analyst noted in April, this isn't just an oil war, it's a tech war disguised as trade policy. And the nations controlling the batteries will soon control the battlefield. For decades, the US dollar wasn't just the world's reserve currency, it was the oil world's default language. Nearly all global energy transactions, from Saudi crude to Russian gas, were priced and settled in dollars, giving the U.S. unmatched economic leverage. But in 2025, that foundation is starting to crack. According to an IMF brief released in April, over 30% of new LNG contracts signed in the first quarter of this year were settled in non-dollar currencies, a dramatic rise from just 17% in 2022. The shift is more than symbolic. In March, Qatar completed its first-ever LNG shipment to China, settled entirely in yuan. A few weeks later, Canada inked a pilot deal with India denominated in rupees, bypassing the SWIFT system altogether. These are small ripples on the surface, but together they signal a deeper current, the beginning of a multipolar energy economy. Why does this matter? Because the petrodollar isn't just about pricing. It underpins U.S. borrowing power, global demand for treasuries, and the ability to enforce sanctions. As countries shift toward bilateral trade in local currencies, Washington's financial reach begins to shrink. Sanctions become easier to dodge. Dollar demand softens. And the geopolitical weight of U.S. energy dominance starts to fade. Economist Nouriel Roubini said it bluntly at the 2025 World Economic Forum: "If energy decouples from the dollar, the U.S. loses more than money. It loses leverage." As Canada and Qatar strike long-term LNG deals that deliberately exclude the dollar, the rest of the world is watching closely. Because if enough countries follow their lead, the dollar's dominance, once untouchable, could soon be optional. As Canada and Qatar expand their reach, they're doing more than redirecting fuel. They're forming the backbone of a new energy order. In early April, both countries finalized a series of long-term LNG contracts, not only with Europe but also with China and India. What's striking isn't just the scale, but the terms. Many of these deals are structured for 20 to 30 years, bypassing traditional U.S. trade systems and increasingly the dollar itself. According to the IMF's April report, this emerging block of supply partnerships signals a shift toward a non-Western energy architecture, one that operates on bilateral trust, localized currency trade, and strategic infrastructure sharing. Diplomatically, the shift is just as visible. NATO's once dominant role in transatlantic energy consultations has been diluted, with bilateral energy diplomacy summits between Canada and EU nations taking its place. Meanwhile, Qatar hosted the 2025 Global Energy Forum, marking the first time the U.S. wasn't even invited. These aren't just snubs. They're signs of a new lane being built, one that doesn't stop at Washington. With Canada investing heavily in Atlantic shipping lanes and Qatar embedding itself in both Asia and Europe's supply routes, the world's energy traffic is slowly merging into a transcontinental network that excludes the U.S. toll booth entirely. Canada and Qatar just rewrote the rules and left the U.S. out of the room. This isn't just energy, it's influence, it's leverage, it's the future. Subscribe for smarter takes and global shifts decoded.